Hello, everyone. Welcome to today's Solution Spotlight. Just going to give it a couple more moments before we really get started, but just going to let people filter in for a moment. So, Tim, you mentioned that you're in South Orange County. Do you like to go to the beach at all, or what is your hobby?
Yeah. Oh yeah. I have a 2.5-year-old and a 16-month-old. And so I've learned that having two boys, you have to be outside all the time. And so we are, pretty much like every Saturday morning, I'm taking them to the St. Clemente as like a local beach that we go to
Hmm.
here that we let them run around on. And so but yeah, gotta love the beaches and
Oh, yeah. And all of the access that you have over there. There are so many beaches down in just that area alone.
yeah, yeah, absolutely. What about you? Where are you from, Sarah?
I'm actually from South Orange County as well, so I'm very, very familiar.
Very cool.
So I just changed my background. This is Monmouth Beach. That's the Atlantic Ocean. This is where I would be sitting on our beach. So it's looking south from there.
Oh my gosh, Tom, I can't even tell that you're not at the beach right now.
Yeah, especially with my Irish tan going here.
Right, right. Well, cool. Let us get started here. Welcome, everybody, to today's Solution Spotlight Beyond Volatility, Building Unshakable Client Relationships in Uncertain Markets. My name is Sarah Williams. I am XYPN's Senior Partnerships Operations Manager. And joining me today are Tim Healy, Senior Account Executive at Nitrogen, and Tom Duffy, CFP, and a whole slew of other alphabet soup behind him. But most notably, he is also an XYPN member and founder and principal of Jersey Shore Financial Advisors, LLC. In today's session, Tim and Tom will share strategies for turning uncertainty into opportunity. And this session is all about helping you build deeper trust and confidently guide anxious clients through volatile markets using risk-aligned strategies and powerful technology to back it up. Before I turn it over to them, I'm going to review some housekeeping items. Now, throughout the presentation, some questions might arise, and that is totally normal. So please do drop them in that Q&A tab below in the Zoom, and then I'll moderate at the end of the presentation, and we'll kick off with a Q&A at that point. But do drop your questions throughout the webinar, and Tim and Tom will answer them during Q&A. And then next, we have a couple of events coming up. Tomorrow, August 13th, is how to launch an RIA as a CPA. And that's really with another XYPN member who's sharing their knowledge about what it means to start an RIA. What are some of the factors that you need to consider when you are also a CPA and possibly combining both of those industry knowledges together. And then August 19th is another solution spotlight, and that is with Money Guide. It is called Is Your Practice Prepared for the Largest Wealth Transfer in History? And this is going to be CE credit eligible, so be sure to check it out or at least think about it, consider it. And then September 10th is an Ask Me Anything with XYPN's compliance team. And they're just so knowledgeable. So any of your compliance anxieties or just biggest questions, please feel free to bring them during that session and they'll be sure to answer them. Last but not least, XYPN Live, our favorite event at XYPN. I know that we're a little biased, but it is truly just such a beautiful industry event. It is less than 2 months away, September 25th to the 27th in Austin, Texas. Please be sure to join us. I will drop a registration link in the chat along with the other registration links for the webinars I mentioned. But if there's anything that you should attend, it's XYPN Live. Definitely my vote. All right. Well, that is it for me. I will turn it over to Tim and Tom.
Awesome. Thank you, Sarah. Well, hey, everyone. Thanks so much for joining us again today. Huge thanks to XYPN for hosting. I know calendars are packed, and so I really appreciate you guys all carving out the time. As Sarah mentioned, today is meant to be super interactive, so feel free to use the chat box to ask questions throughout. For those I haven't met yet, my name's Tim Healy. I actually started out my career as a financial advisor. So I've been in that seat, sitting across from clients, navigating market swings and really helping them stay focused on the long term. These days, I'm a senior account executive at Nitrogen, where I get to help advisors grow their business, deepen client relationships using our platform. So for anyone that's new to Nitrogen, you actually might remember us as Riskalyze. We work with advisors primarily in 3 different ways. We, number one, help turn these complex investing ideas that we use as advisors, the portfolio and analytics, into something that's simple, digestible, mostly as proposals that make it easier for your prospects to say yes. Number two, giving you tools to help kind of set expectations, keep clients steady through market volatility. And then number three, being able to help like document fiduciary care, right? How do we justify our recommendations for compliance? And so today, as we're talking today, we're going to zero in on that second piece, client engagement, how advisors use Nitrogen to guide clients through the market swings with confidence. And before we get into Tom's story, I think it's worth acknowledging the landscape that we've all been navigating the past few years, right? I feel like since 2020, and I joke about this sometimes, but it feels like it's like end times. It's been one curveball after another: pandemics, record inflation, political shifts, supply chain disruptions, interest rate hikes, and clients are feeling it, right? It's no wonder that a recent CFP board study found that nearly 3 in 4 advisors say they now spend more time on behavioral coaching than they did 5 years ago. And so we're no longer just portfolio managers. We're part financial advisor, but we're part behavioral, finance therapists, if you put it that way. And so that's why like how we communicate during these moments matters so much. So the more we can help clients understand what's normal in the markets, the less likely they are going to kind of make these short-term decisions that derail their long-term plans. So quick story before I jump in here. When you're on a flight and the captain comes on before takeoff and he says, "Hey, we're expecting a few bumps about an hour into the flight, but totally normal, nothing unusual. We're still going to land on time." You actually get to relax. Like maybe you grab a snack, you put on hopefully Michael Kitcey's podcast, if you haven't heard of him. But if there's no warning, you hit the turbulence kind of out of nowhere, you start, like gripping your armrest thinking, okay, is everything okay? Even though it's the same exact flight, right? That's exactly what happens with clients and the markets. When they know what to expect, they can ride out those bumps. And when they don't, that's when fear kicks in, right? And they start thinking about making these big changes that could kind of throw them off course. And that's kind of where Nitrogen fits in. Nitrogen's like that pilot, right? It helps you kind of set those expectations early so clients can stay confident through turbulence. And that's really a perfect setup for our conversation today, because Tom, I know you've been through plenty of these market turbulence. You've been through plenty of market turbulence with your clients. And so for those who haven't met you yet, tell us a little bit about you, your firm, Jersey Shore Financial Advisors, who you serve, your niche, and what ultimately led you to Nitrogen.
Sure. So welcome, everybody. I am Tom Duffy, and I am pretty close to the Jersey Shore. I'm not close enough, so I put it on as my background. That is the beach at Monmouth Beach, New Jersey. That's where I would be sitting if I weren't here right now with all of you folks, which is fine. It's fine. Maybe a little later this afternoon, I'll get down there. But usually feet in the sand for me. My firm, I'm a solo practitioner. My claim to fame is I do know Michael Kitces. I've known him for almost 30 years. If I'm famous for anything, that's it, and only that. But I typically work with. The best way is probably think your grandmother. That's who I work with, right? So a lot of folks that are newly widowed, widowers. A lot of times the one spouse or the other handled all the financial decisions, including the investment decisions. And then all of a sudden that spouse is no longer able to do it, either sickness, the disability, they die, something like that. I do have a few folks that are divorcees, so that kind of a similar situation. But a lot of times, I'm talking to folks that they really have very little investment experience, other than that almost inbred fear, especially folks older than us, certainly older than me, that learned maybe from their parents or grandparents that you're better off touching a hot stove with both hands than going in the stock market, right? Because they just don't understand what it means. They don't understand the up and the down. They see it, they read it, they see it on the for folks that still watch the evening news, and it just scares the you know what out of them. So having some tool that helps communicate what do we mean by risk, right? Because most folks, most normal people, the folks that are not here, they think risk is, oh, I'm going to lose all my money. Whereas we know the risk is, it's the volatility, right? It's the up and the down, it's the beta, it's how far is something going to go. Down typically is what they're worried about. And so, having a tool that just quantifies that problem, or that question, to frame the answer so that it makes sense to them. And Tim's story about the pilot telling you when to expect, or just that we will have a bumpy ride, not maybe when it is, goes so far into getting people to just kind of relax a little bit and saying, okay, yeah, we knew this was going to happen. I tell people, I said, we're not supposed to guarantee things. I guarantee folks. I say, look, I guarantee the market's going to go up. I guarantee it's going to go down. When, how often, how far, one way or the other, I have no idea. I just know that it's going to happen. And so as long as we're prepared for that, we should be able to weather that turbulence, if you will.
Yeah, absolutely. And I think you just said right on. We've all seen it. People don't tend to panic when they know what to expect, right? But without that context, market swings, they feel like, that unexpected turbulence we talked about earlier. I think it's like that Dow bar study that we've all seen over a 20-year period. The average equity fund investor underperformed the S&P 500 by several percentage points a year, not because of bad investments, but because of just bad timing decisions.
Yeah.
So our decision is like, we got to close the gap by keeping clients invested through all the noise. So I'm curious, as advisors, we know volatility is nothing new, but are you seeing anything different in recent bouts? Like, what are you hearing from clients right now? Are their expectations shifting?
Well, so it's funny. My clients, I haven't heard a peep, which I can only attribute to that that I've done a decent job, maybe a little more than decent job, of educating them that volatility, things happening in the market, especially the equity markets, these are to be expected. And there's the old stock market chart that goes all the way back to the 1900. We can show them through everything. You mentioned political upheaval. You mentioned business cycles. You mentioned new technology. All that stuff, through everything, the market has always come back, and it has always gone higher. Because it's funny. So the fellow that I share office space with here, he's always, the market's at a new high. Now, he's not a financial advisor. He does something else. But the new market high, and then you read a headline that says, new market high, the market's due for a decline. And I scratch my head, and I asked the guy, I said, Toby, what do you think happened immediately after that new high, that record high? What happened next? Well, what do you mean it happened next? I said, what happened immediately after that? Did it go down? Sometimes. And then what? It went up again. So there's always a new record close or a new record high on the market. It's happened every time. So should we be afraid of market highs? Maybe, but if we are, we're never going to get to another one. If that's what our concern is, that, I got to get out now while we're at the high. Okay, say you do that and say you were right, and the market did go against you. Now what do? You're out. That's a problem. And so, again, having some type of tool where we can illustrate what it means to go down, to have that decline in your portfolio, and how far you go down. We talk about volatility, right? Extreme volatility is what kills. Volatility is not necessarily comfortable, but it's kind of required, right? If we're going to move ahead, it's kind of, it's like diet and exercise, right? We got to go through some pain to get some gain there. And sometimes the stock market is something similar to that. But having that tool that we can, we can show folks, and that's what I had looked for, I think most of us look for something to be able to communicate to our grandmother clients, right? What does it mean to be in the stock market? Now we can spout statistics. I was on a thing yesterday. They mentioned Sharpe ratio and this and that, and they were talking about credit rate swaps and all kinds of crazy. I'm like, I could never, I could barely explain it to myself. I'm certainly not going to be able to explain that to a client. And why I would lose them immediately. We start talking about, they're credit default swaps and credit rate swap, all kinds of crazy stuff, which made perfect sense, right, to the advisors in the room. But to be able to communicate, forget it, not doing it, not doing it. Can't do
Yeah,
it.
that kind of reminds me. I think FINRA did like a study back in, I think it was like 2018 or so. They showed that 2/3 of high net worth individuals couldn't answer basic financial investing questions.
Yeah.
And
Yep.
it, like, basically, what does that mean? It just means that I think that the more and more we need to kind of convey these concepts, and the alphas, the betas, the standard deviation, drawdown, all these different terms that we use advisors in a way that makes a little more sense to clients, especially when we're trying to, we're working with clients that are in like the decumulation phase, and
Yeah.
now they're reliant on these portfolios for income. And so how do we communicate this in these choppy markets? Before we kind of dive into nitrogen, I was curious, for the XYPN members here who might be earlier in their careers. I was just curious, Tom, if what advice would you give on building trust, in those first like 5 years?
Listen, and you'll read this everywhere, is, you have two ears for a reason, right? That's because we're supposed to listen twice as much as we talk. And I will admit, and even still, I often find myself talking too much. So yeah, listening to clients and really trying to figure out what it is that they are really concerned about. We're going to have our agenda for the meeting, but the best thing is to reserve the first three slots for the client's agenda. Ask them, what are the things that keep you up at night? What wakes you up at night? What makes you concerned about not being successful? And making sure that we capture that and that we revisit that. Not so much to poke them with it, but just to, how are you feeling about, your family had an experience with the stock market, let's say. How are you feeling about that? Instead of, just coming in and, as professionals, we think ourselves as professionals, hold ourselves out as professionals, to just come in and say, yeah, well, my professionality will override all of that stuff. I'm just going to ignore your fear because I'm going to build you a nice portfolio that's perfectly balanced. Yeah, that's not going to do it. They're gonna say, well, thanks very much. Have a nice day. And you never hear from them again, because we really have to be able to address their concerns, their fears, and I think we can answer their questions using what our agenda was, what our goals were for the meeting, but use their words. I think we're a lot better off, instead of using, some, I hate to say it, but like a script or some type of canned sales thingy. That's probably not a great analogy, but that's kind of what I'm thinking. Using the client's words is probably the best way to answer any of their questions.
I love that. Okay. And I think that's a perfect segue into kind of deeper, like a deeper dive into nitrogen. But I think to add to what we were just talking about, having that repeatable framework, obviously having the conversation, understanding expectations, but what processes we use as we are bringing on new clients is very important, not only for you, so that you can become great at your craft, but having that repeatable framework so that it's this more scalable, so that we can ultimately meet those clients where they're at today. Tom, I'm curious, for folks that haven't used nitrogen before, can you kind of walk us through the risk number? What it is, how you like to introduce it to clients?
Sure. So the risk number, it's great that the imagery, it looks like a speed limit sign, and the clients are going to answer a questionnaire, which you can either send that to them and let them slog through it on their own, or you can do it on the screen. I kind of prefer to do it on the screen because, believe it or not, clients hate to answer questionnaires like that from us. Your portfolio goes down by 20%. How do you feel? Well, terrible, of course. Scared. Like, how did this happen? Well, what if it goes up by 20%? What now? Now what do you feel? Elated, fantastic. You're doing a great job. I didn't do anything. I'm standing here. The market did that. I had nothing to do with that. I may have had you positioned appropriately, but I had very little to do with the up and the down. So the risk number gives us a framework, a relative number. And based on their responses to the risk questionnaire, and I'm not going to say it's the same as everyone else, but they work similarly, right? To gauge the client's their capacity for accepting risk or the up and the down. Really not the risk, it's the volatility. And so we use that number, and I always compare it with clients. I compare it to so every New Jersey joke you've ever heard is, what exit do you live off of on the Garden State Parkway, right? Ask Jay Leno, he'll tell you all about the Garden State Parkway. Exit 105 is my exit. I can get on at 109, but it roughly corresponds to the length of the Garden State Parkway north to south. So we travel on the Garden State Parkway quite a bit. So I'll ask a client, look, you have 60 miles to go. You have 1 hour to get there. How fast what does your speedometer say? And they kind of look at me and I said, well, if you have 1 hour, and you have to drive 60 miles, you should probably be going 60 miles an hour, right? 60 miles per hour. That's 1 hour. You drive 60 miles. That'll get you there. The thing is, on the Garden State Parkway, if you're not doing 80, you must be broken down. I would hazard a guess that's true on many highways. But the problem is that if you have an 80, right, if your risk score comes out at 80, especially when we look at your actual makeup your portfolio, that means you're probably driving a lot faster. By reference, the S&P 500 is roughly 74, 78, somewhere in that area on the risk number. So if your portfolio comes out higher than that, that means that your portfolio is probably a lot riskier than the market as a whole, if we use the S&P 500. And so I compare that to driving on the Parkway. So if you only have 60 miles to go, why are you driving 85? Right? Because now you've got excess wear and tear in your tires. Your car wasn't designed to drive that fast. You're burning more gasoline than you need to. If the New Jersey State Troopers are out, you're going to get pulled over and get a ticket. And if a deer runs out in front of you, you're going to roll your car over. Now, if you tone that down a little bit, and now you're closer to your risk number 60, which is what will get you there safely. That's the way your car was designed to go. Your tires are designed that way. The cops are going to leave you alone. Sure, a deer could still run out in front of you, but you're going to swerve and then you're going to stay on the road. You're not going to roll it over into the ditch. So having that frame of reference and that risk number just provides that frame, that point of reference for clients to realize how much riskier, how much volatility should I expect versus the S&P 500, which goes right back to our turbulence story at the beginning, like how much risk. So I can actually show a client, and I'm not sure if I should be able to share my screen here. Let's see if I can get my screen number 2. So hang on, everybody, hold your breath. We're going to share. Okay, cool. So let's say our sample client graded out to a 50. We did the risk questionnaire. They either did it themselves or I walked them through it, and their risk number came out at 50. Well, I took the liberty of loading in their current portfolio. Now, this is one of my, actually an existing client. This was their portfolio quite a while ago. But I loaded in there, and this was kind of odd. It's unusual portfolio because they got a bunch of Google in here, and then some funds. This was really strange in this client. I think it was his IRA. So it was about 110,000, tiny account. This was in addition to his wife actually has all the money. But so they just this stuff in there, right? So a municipal income fund, small cap ETF, again, very odd, right? A bunch of Google, and some other, so this couldn't have been his IRA. This was because he's got these munis in here. Anyway, each one of these positions has its own risk number, right? So if you own Google alone, that's a risk number of 92. So our volatility, we would expect it to move quite a bit. right? If you had just this muni income fund, that would have a risk of 65, right? Cash obviously is a 1. We're not going to move very much there. So if we were to aggregate this and weight it all out, this portfolio in and of itself would have a risk number of 74, right? So what that means is, and I'm going to scroll over here to the right a little bit. What that means is that a portfolio with that kind of makeup that had a risk number of 74, right? Over the next 6 months, I think it would be reasonable that portfolio could be up as much as 21.79. I'm on the right side of the screen here, or it could be down as much as 16.24%. And so that kind of tells us that should be the range. That's the amount of turbulence you should expect, up or down. That doesn't mean that it'll stop at 21.79. It means it could go higher than that. Certainly could go lower, go down further than 16.24. But basically 95%, I guess, probability, right, that over the next 6 months we could be in there. We show the client that, okay, that particular portfolio is 59.4% in stocks. It's got 39% in bonds. So we can tell them this is what's in that portfolio, right? Now, we could also go as far as to say, okay, what would have happened if we went through the 2008 bear market, right? The current portfolio's got a risk number of 74. That type of portfolio, we would expect it to be down 22% in that 2008 bear market, right? The S&P would have been down 36%, actually a little bit further down, even though the risk number is a little bit lower. If we went through the full crisis, 2007, right? October through March 2nd, 2009, everybody bought on March 2nd, right? That's when everybody bought it. We got at the very bottom, we all bought in there. Yeah, we would expect that 74, the current portfolio, to be down 32%. If you owned only the S&P 500 through an index fund, right? Because you can't buy the index, you'd be down about 53%. So we can tell people, yeah, you're not as bad as the S&P 500. We wouldn't expect as much turbulence, but pretty close. I mean, that down 32% is, that's life-threatening for many folks, right? When I say life-threatening, that means they're going to bail and they're going to sit on the sidelines, probably until the market goes back up, and then it'll be too late to get back in. What happens? What if we went through the 2013 bull market, right? So given your portfolio with a 74, we would expect it to be up 20%. The S&P would be up almost 32%. So we can show them kind of a frame of reference. I won't go through all of this stuff, but I can give folks a frame of reference, and often with a lot of folks that they just never had that frame. All they knew is the market goes down, right? Ask anybody. That's all it ever does, is go down. Just not every day, right? So we can do that, and then we can say, oh, well, suppose you wanted to make a proposal. So I'm going to click on proposals. I just threw one of my model portfolios. I built some model portfolios. Actually, these are State Street Globals. They have them on their website if you want them. So I said, okay, and I chose one, right? Remember, the client graded out at a 50. So I said, okay, what do I have that's close to a 50? So I had a moderate growth portfolio. You can see what it all has in it. Each of the individual components, some of them are riskier than others, right? An emerging markets fund, you've got the S&P 400 in there. The 600's got a risk number of 89. So you got some stuff in there that might be pretty volatile, right? So we got some tips, all this stuff. And I don't even know how current, I haven't looked at this model I don't use it very often. So I'm not even positive how current it is compared to what State Street would give you right now. But what I could show the client in this instance, I would say, okay, this portfolio, we would expect that it might be down 10.31% or up as much as 16%, right? Again, those are not guardrails per se. Those are more like white lines on a country road. You can still go further off the road, but that should give us a pretty good guideline. And this one's 55% stocks, 40% bonds, very similar to your current portfolio, right? But when we look at stress tests, we can say, oh, wow, this is not compared to the current portfolio. I probably should do a little more work to do that. But compared to the S&P, we got half of the risk of the S&P, well, actually less than half the risk of the S&P 500. If we go through the full crisis, we've got 26, that's half, right? If the bull market, we get about half, right? So we're basically cutting all that in half, but our rate of return, I'm pretty sure, was close to the same as what the current portfolio would be, but we wouldn't have as much volatility, right? It's the up and the down that drives people bananas. It's the thing that scares your grandmother when the market goes down and she sees on the TV that, oh, the S&P is down, whatever it is, and she thinks her portfolio went down the same amount, even though it didn't, because she doesn't own 100% S&P. So that's a lot of the way that I can use this, this risk number, this speed limit sign to create that frame of reference to help guide that conversation with folks so that they understand that, yeah, we're going to have to take some volatility. We just don't want to take a lot of it. We want to take some of it. And using this risk number to give them that frame, that seems to help quite a bit. And like I said, I haven't had a phone call on the market, back in April when we had whatever that was, nothing. Crickets I got. People, I was actually on a ski lift and people, oh, your phone must be blowing up. It's like, no, I haven't heard from anybody. Nobody said a word because somehow we got them into the right risk number style portfolio that they know it's going to move, but they're just not worried about, a certainly life threatening event.
That's really good. Thanks for context there. So it sounds like we kind of talked on, not only how we can use this from a prospecting standpoint to highlight those misalignments like you did there, Tom, where, hey, client wants to be a risk 50, right? But they're going 74 miles per hour down the highway. Hey,
yeah.
We're a little bit off here. That's a compliance red flag. And then it's like, hey, let me show you where you should be invested with regards to not only how you feel about risk and reward, but also, this is much more, we can get you there. We can still reach your goals. We're on track to reach your long-term retirement goals. And for context, I know some of the folks were chatting in, 1 to 99 is our scale. So think 1 is like cash, 99 is like throwing all your money in Bitcoin. So the higher the risk number, the more volatility you can expect. Every risk number is tied to a specific amount of volatility on the downside. And what makes nitrogen different is we score every security. So we go down to the security level as opposed to using default capital market assumptions at the asset class level. A lot of these planning tools, eMoney, Right Capital, Money Guide Pro, they use default capital market assumptions, right, at the asset class level. Whereas we're going to say, no, not all large cap growth stocks are the same. And we'll be able to kind of help really flush out and crystallize what's normal for that account or grouping of accounts up to a household, so that you can really be proactive with those clients and talk about what's normal, what expectations there are. And Jason, I see your question. What software can show the risk score? Maybe you can elaborate a little bit more there. If you don't mind, I'm curious to unpack that question a little bit more there. We are talking about nitrogen that can show the risk score 1 to 99. So that's what we're talking about today. Kylie, just to touch on your point, how do you explain the lower risk value for the S&P but higher volatility in those stress tests versus your client portfolio? I'll have to go back to check on the case that Tom put together. But again, we are looking at based on the actual holdings of the portfolio, and we're able to stress test compared to, the 2008 bear markets, these previous market events that we've all lived through, 2020, 2022 inflationary environments. And we'll take that portfolio and we'll be able to, see how that portfolio during that time would have done, so that you can kind of compare. I think John, let's see here, John, can you explain the difference between the risk score and a simple beta score? Yeah, so the risk score, and Tom, you might have to help me out here, some beta questions, but maybe let's see if you can handle that one.
So the way I would think of this, and I would just basically, so beta is typically the, let me think, as I haven't answered this question in a long time. So is the percentage of the volatility that you're going to see in an index. So if you have a beta of 1.2, that would mean that whatever you're measuring would be 20% more volatile than the S&P 500, right? So that's just a simple more volatility. I think the risk score, because they go much deeper on a security by security, we can actually pinpoint how much more volatile or less volatile, I just point that out, volatile, more volatile or less volatile than that individual security than the market as a whole, right? If we want to just, you're right, beta is much easier and dare say free to say, yeah, your portfolio is 20% more volatile. But that's, I don't think that's enough in a lot of cases because most clients aren't going to have just the S&P 500. Right. So, and so having a portfolio that you're going to do some kind of aggregate beta of, I don't know that that's actually accurate. Right. Because if you've got bonds and stuff in there, you can say, yeah, compared to the S&P, bonds are, I don't think that's I don't think that's a right comparison. And I don't think it's going to be, I don't think it gives us enough information. Um, I think having a much more detailed number, um, is better for clients so we can show them, especially when we can go in there and show line by, especially for a prospect. Tim mentioned, as a prospecting tool. Now I don't use nitrogen as well as I should or as much as I should as a prospecting tool, but being able to say to somebody, yeah, provide me your positions. Yeah, black out the top of your statement. I don't want your account number, but tell me what you have in your portfolio, or connect it digitally, like we do everything today, right? So we can actually go over, line by line. We can say, and I'm going to share my screen back here, if I can. I'm actually probably on the wrong. Oops, sorry about that. That's the right screen. Share number 2. I have 3 screens, so it's hard to figure out what I'm doing. So I'm going to go back to this guy's current portfolio. So you can go into each fund. Hopefully we can see this here. We can actually dive down. I probably should have mentioned this before. And Riskalyze or nitrogen, pardon me. They give us quite a bit more information about each individual security, which you're not going to get just by saying, oh, beta, right, of your portfolio. We can look at each holding, and we could go so far as, open the Google here. This is the Class C, right? We could say, oh, worst case scenario in that position, we might see it down. It could be down as much as down 30%, as up as much as 36%, right? So that's quite a bit. We can show clients the error of their ways, or how aggressive either they are as their own portfolio manager, or whoever they're working with currently that we're trying to get them to come away from. We can show them, yeah, your current portfolio is probably a lot more aggressive, probably a lot more going to have a lot more volatility, or higher levels of volatility than you need, especially when it comes to what your goals are. And that's been my experience. When I bring somebody over and they're coming from one of our friends outside of XY, right? One of the broker dealers, I often find that their portfolio is way more aggressive than it needs to be, because technically it's being managed by the home office, and that advisor, and I'll use that term loosely, they're so afraid that they won't outperform the S&P 500 that they'll get fired, right? They think that's what the goal is to outperform the S&P 500. Well, in my opinion, that's not it. Our goal is to get the clients to drive that 60 miles and get there in one piece. That's our goal. That's my goal anyway. Certainly, with my clients, they're all retired. They're not going to go back to work and recreate their portfolio. I don't know any client that would. Be able to do that. So, being able to get them where they're going with a moderate amount of comfort, right? Not way up and down, but keeping that volatility. I think that's really important, to be able to demonstrate that to clients, and giving them so much more information. I hope that's helpful. Probably too much.
No, that's really good. Yeah. So again, what's kind of happening behind the scenes is, just so you guys all understand, every security, well, we're basically, all of our data is rooted in 2004. So we're using daily price history, right, to feed nitrogen for Google for every security that's comprised in the portfolio. And we run that through a 2 standard deviation value risk calculation, right? So that we can quantify what's normal. So every risk number is tied to the volatility on the downside, right? And so when we do that from an account level or grouping of accounts all the way up to household, it allows us to really have now finally this common language around how much risk a client wants to have, right? Client wants to be a 50, right? Which means that they're cool with a certain amount of downside, right? Before they capitulate, they make that emotionally charged poor investing decision to go to cash. But then we can really highlight, hey, you're going 74. You're taking on $60,000, $70,000 more than what you're comfortable, in your current portfolio. Let me stress test. Let me show you what that would actually look like. And then it really helps you set up the conversation of, hey, let me show you where you should be based on the volatility.
Tim, we can also show them, the client, we can show them the expense ratio. So that comes in there that sometimes, depending on where that portfolio is, how many portfolios have we seen that are, they're stalwart mutual funds, mutual funds that were founded in the 1950s and 60s, right? They're 70 some odd years old, or getting close to that. And they've got track records going back forever, but they're amongst the most expensive funds there are. Plus this, we also estimate the tax drag, especially on a mutual fund. That's, anybody have any capital gains distributions for clients last year? Holy cow, did that hurt, right? So we can show them that as well. Now, I want to tie into financial planning. So I'm a cash flow planner. The way my brain works, I use eMoney Advisor. So the risk number does flow in. Now this should be a sample client. Yeah, this is a sample. This is my eMoney homepage. This is a sample client. The numbers are all completely crazy, but the risk, I can connect and bring that risk number in here, and then I can send the portfolio from eMoney back over to Nitrogen, so I can make sure that they're tied together. But where this makes sense is from a planning standpoint. Again, I'm a cash flow guy, so when I do planning with clients, I'm gathering as much cash flow information as I can. I tell clients, look, I want to know where every $10 bill goes. I want to know how much does it cost you to be you, because that's what our baseline is going forward. We're gonna start lobbing things in there as life goes on. You got to change. You're gonna stay in your house, great. You're gonna have to replace your roof someday. You got to replace your HVAC. How often do you buy a new car? Is it a new car, a new to you car? What are we doing here? How much money do you want to give away? How much are you gonna spend on vacation? The big stuff. Again, cash flow. I spent a disproportionate amount of time on cash flow. But then I can go back and say, okay, based on what we think your cash flow is going to be, we can make some reasonable assumptions about rates of return. And I'm trying to find the lowest rate of return that will get you to arrive at your destination, so that I don't have to go and put you 100% into the S&P 500 or the 600 or the Russell 2000. I don't have to take on so much more risk in order to achieve a return number so that you can have the cash flow that you want. I want to try to get that number the opposite way. That way, because if I get them the lowest rate of return, not the lowest, but the lowest rate of return that will accomplish their goals, I've also minimized their volatility, which ratchets up their ability to stay invested when things go south, because they will. I guarantee the market will go down someday. When and how far, I don't know. But at least if I've tied those two things together, and I show clients that, I said, when I come up with their cash flow, and I said, this is based on having a portfolio with a risk number of whatever it is, 38, 30, 50, whatever that number is. And so I have some reasonable assurance to myself that they're going to be okay, and they don't have to take on a disproportionate amount of risk.
I love that. No, that's really helpful. I think I heard this at a recent conference. I think so tie that in with the planning conversation. The number one reason plans fail is typically not because of the work that advisors do, right? But it's because of clients making short-term irrational decisions. And so that's where, like, the two, if I'm hearing correctly, it's like eMoney is going to help, like, look at the big picture, cash flow, taxes, do we need to consider RMDs at some point in the future? Income, expenses, assets, liabilities, right? But then Nitrogen is going to help kind of look at, okay, based on the actual underlying holdings, like, not only are we appropriately set up correctly, but like, can we withstand the emotional, roller can we withstand the, volatility in the current accounts that we have you set up in?
Right, because we have, especially if we have somebody that's coming to us that maybe they have been managing their own portfolio and they don't know they don't know how they got where they are, right? So I had a prospect one time, so she ended up not becoming client, but she had a ton of VUG, right? The Vanguard. She managed her own money. So everything was in VUG, and so and she was deathly afraid that it was going to go down in value. I said, okay, well, it's gonna, like, when the market moves, it's gonna. What do you want to do about that?
Yeah,
She had
absolutely.
she had no answer, and I said, okay, well, that's the so maybe we should be judiciously paring that back over time, agreeing that, yeah, you're going to have to give up some account value increase because you don't have as much, right? And some tax cost to limit that volatility. But that's the problem, is that she didn't want to give up any of that. So okay, and that, I'm pretty sure that was in 2019, that 2018 maybe, that I talked to that person. So she went through everything that we've gone through since. She's still at market highs now, but she had to go through some stuff since then and now. And whether or not she had to make or was forced into making any changes, I don't know. So that's the thing. And very rarely, I think, do we get clients that come in and say, look, I want the highest possible rate of return. Right? Okay, then buy Bitcoin. If that's what you want. Early in my career, we had a client that came in with Money Magazine. He had torn the page out, and there was a Russian currency fund that had like a 300% rate of return. He goes, that's what I want. We're like, okay, we're going to sell all the stuff you have, and we're going to buy that Russian fund, because that's obviously the only way you can get that. Oh, that's not what I meant. I don't know what you meant, but I know what you said. Right? Nobody ever does that. So, being able to create a portfolio that has that, that can give them that comfortable ride up the Garden State Parkway to wherever that rest stop in the sky is. That's the idea. Let's keep the volatility within a normal range, an acceptable range, an appropriate range. Get them where they want to go, so that they're not jumping out the window.
Yeah, no, absolutely. With the time that we have left, so we've kind of talked about just like high level, some of the prominent features here. It's like the risk numbers and being able to kind of set expectations, generating like the best fit proposal. But I was curious, Tom, I guess, do you have any examples of, any examples like how you handle a client who is, kind of they're way outside of their comfort zone, or maybe any examples where nitrogen like helped prevent a bad client decision. I was curious if you had any insight there.
So yeah, I do. More along the lines of early on when I first started using, back when it was Riskalyze. I had a client that she wanted to make wholesale changes to her portfolio because, as a result of some volatility that was going on in the stock markets. And I said, okay, well, can we review your risk number and what has changed that I don't know about? And we went back through, and I'm sure we would have gone back through the questionnaire to come up with what her risk number was. And we said, okay, so you're comfortable with whatever it was, 32, 38, 50. Well, it doesn't matter what it is. And then we compare that to the current portfolio, and then I do the stress test, which shows, okay, this portfolio during the last worst market we've had, this is what it would have done. Is that acceptable or not? And that's kind of how we came to terms with, okay, yeah, I think I can, on the downside, because the neat thing is, I don't know if anybody noticed this, and I'm going to share screen again. Try to do this fast, and we'll run out of time. One of the things that this does, besides the percentage change, it also gives us the dollar change. Because let's face it, not many of us think in percents. We think in dollars. Certainly, clients think in dollars. Oh, my $110,000 portfolio, or my $11 million portfolio, right? It went down by what? 18,000 or 180,000 or whatever it is. That's kind of the way their brains think. So if I was able to show a client that, yeah, if we're able to change your risk number and get you down to a 53, and so now you're only losing 10% or 11,000, not 18,000 or 180 versus the 110, depending on where your decimals are you going to be able to sleep at night knowing that that's the possibility, but also that you also have the upside? Because sometimes they'll say, oh, well, I really don't need that much upside. Okay, great. Then let's do something lower. Let's I have a, we have another portfolio that's not moderate, it's something less than moderate. So our volatility should go down, our expected rate of return should go down, but we certainly would tighten up those two numbers. You'd be down, 7,000, maybe up 10, right? So that's a lot of what the questionnaire takes people through. It's like, okay, you're comfortable with down 11, up 17. How would you feel with down 9 and up only 5? Is that better? And that's basically where how we go through. There's 7, 8, 9, 10 questions to try to narrow it down to what range do you want to be in. So that certainly helps people. And so when you have somebody that is preparing to make a big change based on an outside source of information, and I'll use information loosely, right? How do we prevent them from making, an emotional decision on a financial matter, right? By actually taking them back and say, okay, well, let's go back through. How do you feel about risk, and where your parameters? What's changed? And if nothing's changed, well, at least we, and we can talk them through. Yeah, we're paying attention to this. We've built this portfolio to work over time. It may not work every time, right? There's going to be instances where all of our portfolios are going to move one way or the other more than we expected. But over the long range of time, that's what we're trying to, 60 miles is a long way to go. If it's 60 years or 75 years or 30 years, it's a long way. And so again, trying to mix my metaphors as best I can to try to keep them from making that fatal mistake. That's our job, right? To
Yeah.
provide them with enough information to make good decisions.
Yeah, absolutely. Well, thanks. Thanks again for sharing some insight there, Tom. Before we kind of open it up for Q&A, I know we kind of did a little bit of hopping around today, but hopefully what you saw, just kind of summarizing, we talked about, hey, how do we visually bring these concepts that are typically pretty complex, the alphas, betas, like in a way that makes sense? How do we talk about risk rather than using the typical conservative, moderate, aggressive approach, and actually quantifying it, right? In a way that makes sense for the client using storytelling. We discussed like how we can have that kind of side-by-side visual of, hey, here's where we're at today versus where you should be. One thing we really didn't touch on today, which we can obviously further explore, but we do have some like client engagement aspects. We have something called we call check-ins, which is really powerful. As once they become clients, like how do we keep them engaged, with regards to the client reviews and things like that are coming up. And so really powerful tools to make sure we're just aligning there with expectations.
I just had a whole bunch come in. I'm trying to see if there's one I can pull up here. I can look at my email. I think they went to the other folder. Sorry, so I can't find them. But yeah, I just had a whole bunch come in. So you set those check-ins. It just sends an email to the client. Like, how do you feel? How do you feel about the market?
Yep.
Positive. It's just, it's 2 questions, which goes a long way to, if somebody's fixing to climb out onto the ledge, we should know, right? Because we'll get that email. But it also helps when your regulator asks you, how are you keeping in touch with your clients about their portfolio? And you say, well, annually I update their IPS, because that's one of the things that the tool will help us to create some client reports. It'll also help us formulate your investment policy statement that you can send to the client for signature or not. But we can say to the regulator, I had to say to the regulator last year, well, this is how I do it. And by sending, that's one of the ways I do it is by this check-in. And they're like, well, not everybody responded. I said, yeah, well, I can't force them to respond, but the requirement is that I ask them for the information. If they decline to respond, there's not a lot I can do about that. And they're like, yeah, okay, we get that. But at least now they know that we have a proactive method of going out to the clients to say, okay, well, how do you know whether something's changed or not? They kind of gave me some static because somebody's portfolio, their risk number hadn't changed in years. I said, yeah, they're retired. They didn't need to make any changes. Why would they change it? Activity is not required, right? They're retired. They're living off everything. They didn't have to change their portfolio makeup. So that's why the risk number is the same, and their portfolio reflects that.
Yeah, absolutely. Well, thank you guys again for jumping on today. I know we have just a few minutes left. So I was thinking we'll spend the last few minutes answering some questions. I know there's a couple that jumped in recently here. And I think Sarah's going to hop on and help moderate the last portion here. And then we'll wrap this session up.
Yeah, absolutely. Before we do, I just want to give some space. So, Tim, if anybody has any questions about nitrogen or is interested in learning more, how do they get engaged with you?
Yeah, I'll go ahead and drop in this link on the chat here, so that we can you guys can schedule some time with our team, and we can go through. Typically, we'll do like a sample case or go through like a real client portfolio or one of your models, so that it actually brings this to light in a way that with one of your actual models. So yeah, we'd be happy to set up a call with you guys if you guys have additional questions.
And I'll be at XY in Austin next month. So, if you buy me a coffee or a beer, I'll tell you anything you want to know.
Anything, not just nitrogen, is that what you're saying?
Anything. Yeah, you may have noticed. I'll opine on anything.
Perfect. Cool. Thank you for dropping that in the chat, Tim. Yeah, some questions. I'm gonna drop or jump over to the Q&A because there's just one that came through, but someone anonymously asked, is there an ideal number of securities to have within a given portfolio? Is there such a thing as too many or too few?
Yeah, that's a good question. More of a technical question. I would say we just recently had an update, kind of like going from the iOS 10 to iOS 15 or 16, wherever we're at with our iPhones today. But we basically can safely take up to about 750, 800 securities today, and we're only looking to expand that. So that can be safely within one household.
Perfect. And then the other one that I'm seeing in the chat, can you change the benchmark to something other than the S&P?
Yes, great question. Absolutely. So we have something called scenarios. So that's kind of where the stress test, you can actually go underneath our stress test and you can swap out the S&P 500 for one of your own benchmarks, or if you build one of your own, you can compare that next to a model that you built, so that you can have a better comparison there than just the S&P 500.
Great. All right. Well, I think that you answered the rest of these questions that were in the chat. There is nothing else in Q&A right now, and we're nearly at time. So I think that we can wrap this up if no one has any other questions. Oh, what tools did Thomas demo?
Other than Riskalyze or other than nitrogen, well, it's so long ago. I used the tool for a long time. Then I stopped for a little while. The fee structure changed, and then they changed it back and became. So I mentioned I'm a solo. I don't use all the portfolio allocation tools. I have looked at a couple of the other ones that are out there now. Nothing really is that much different. And to be honest, my clients are trained. They recognize, if they're going to ask me a question, they're going to ask about their speed limit. That's, so that's how I know it's an investment thing. So, but today we looked at the nitrogen, and I did show that does sync with eMoney Advisor, and I'm fairly certain. I'm just drawing a blank here. It also integrates with my CRM. So I use Redtail as my CRM. So I think it also, certainly the emails get archived in there. I'm fairly certain that it also gives me the risk. I'm drawing a complete blank. You can tell it's summer. I'm not working that much. But certainly eMoney right on the homepage for me, we can sync I can bring the risk number back over from nitrogen, and then I can pick and choose which portfolios that are in eMoney to send those back over, and then use that in the current to gauge the current portfolio risk number.
Amazing. Cool. Well, we are nearly at time, so I'm going to wrap us up. Thank you, everybody, for joining us today. If you are interested in joining XYPN membership, I just dropped a link in our chat. Schedule a call with an XYPN team member. We can talk you through any of your questions that you might have. And then if you are interested in nitrogen, then click on that link that Tim shared to schedule a demo. And last but not least, we thrive on feedback. We love feedback and knowing what you're interested in hearing from next or hearing about next. So there is going to be a feedback survey when you leave this webinar. Please be sure to fill it out really, really quick. Otherwise, thank you, Tim. Thank you, Tom, for coming and sharing your knowledge with us. Really appreciate having you both. And I hope you guys have a good rest of your day.
Fantastic. See everybody in Austin.
See you then.